If your business is making sales but your bank account still feels tight, you are not alone. Negative cash flow is one of the biggest silent killers of small businesses. In this video, we are sharing how to fix negative cash flow in your business. The first step in fixing negative cash flow is understanding that profit and cash are not the same thing. Many business owners look at their income statement and see a profit, but their bank balance tells a different story. Cash flow is about timing. If customers pay you in 60 days, but you must pay rent, payroll, and suppliers in 30 days, you will experience pressure even if you are technically profitable. So begin with a simple cash flow audit. Review the last 3 months and list every source of cash coming in and every payment going out. Separate fixed expenses like rent, insurance, and salaries from variable expenses like materials, shipping, and marketing. This clarity alone often reveals the real problem. Next, tighten your receivables. If you allow customers to pay in 60 days, consider reducing terms to 30 days, or even requesting partial upfront deposits. For service businesses, require at least 50% before starting work. Send invoices immediately, not at the end of the month. Follow up consistently and professionally. Even improving your average collection time by 10 days can significantly improve liquidity. If late payments are common, introduce small late fees or offer small discounts for early payment. Speeding up inflows is usually easier and less painful than cutting everything. Now look at outflows. Negotiate with suppliers for longer payment terms. If you currently pay in 30 days, ask for 45 or 60 days. Many vendors are open to this if you communicate early. Review subscriptions and recurring software costs. Cancel tools that are not directly contributing to revenue or operational efficiency. Examine inventory carefully. Excess inventory locks up cash. If you are holding more than 90 days of stock, you are freezing working capital that could be used elsewhere. Consider discounting slow-moving items to convert them into cash quickly. Cash today is often more valuable than full margin months later. Another foundational move is creating a rolling cash flow forecast. This is not complicated. List expected cash inflows and outflows for the next 12 weeks. Update it weekly. This forecast allows you to see problems before they happen. If you notice a large tax payment or insurance renewal coming in 6 weeks, you can prepare instead of reacting. Many negative cash flow crises are not surprises. They are simply ignored warnings. Evaluate pricing. Many businesses suffer negative cash flow because prices are too low relative to costs. Review your gross margin. If your variable costs are rising but your pricing has not changed in years, your cash position will slowly weaken. Even a modest price increase of 5% to 10% can make a meaningful difference, especially if communicated properly with clear value justification. Customers who value your service are often less price sensitive than you assume. Fixing the foundation means improving timing, tightening expenses, managing inventory, forecasting proactively, and ensuring your pricing reflects reality. These steps alone can shift a business from constant stress to controlled stability. Once the foundation is stable, you can move into more advanced strategies that not only fix negative cash flow, but make your business more resilient long term. Start by analyzing your revenue structure. Not all revenue is equal. Recurring revenue, such as subscriptions, retainers, or service contracts, creates predictable cash inflows. If your business relies heavily on one-time sales, consider how you can introduce recurring elements. Even converting a small portion of your customers into monthly contracts can smooth volatility and reduce cash pressure. Predictability lowers risk. Next, review your customer concentration. If 1 or 2 large clients represent a major percentage of revenue, your cash flow risk is higher. Diversifying your client base protects you from sudden payment delays or cancellations. At the same time, focus on your most profitable customers. Use simple analysis to identify which products or services produce the highest margins and the fastest cash cycle. Prioritize marketing and sales efforts around those offers. Growth without margin discipline can actually worsen negative cash flow. Working capital management is another advanced lever. Calculate your cash conversion cycle. This measures how long it takes to turn inventory and receivables into cash after paying suppliers. Shortening this cycle strengthens liquidity. You can reduce inventory days, collect receivables faster, or extend payable terms. Even small improvements across all three areas compound into meaningful cash gains. If cash pressure is immediate, consider short-term financing options carefully. A business line of credit can provide breathing room during seasonal dips. Invoice factoring or invoice financing may help if receivables are strong but slow. However, use financing as a bridge, not a permanent solution. Borrowing without fixing operational inefficiencies only delays the problem. Always compare the cost of capital against your gross margin to ensure the math works in your favor. Cost structure optimization is also critical. Look beyond cutting expenses randomly. Instead, align spending with revenue drivers. Invest in marketing channels that produce measurable returns and eliminate activities that do not move revenue. Outsource non-core tasks if doing so reduces fixed overhead and increases flexibility. Flexible cost structures are easier to manage during slow periods. Another advanced tactic is building a cash reserve policy. Once you stabilize, aim to accumulate at least 3 months of operating expenses in a separate account. This reserve acts as shock protection. It allows you to make strategic decisions calmly rather than react out of fear. Businesses with reserves negotiate better, invest smarter, and survive downturns more effectively. Create a culture of cash awareness inside your organization. Train managers to understand that every decision impacts cash flow, not just profit. Review cash metrics monthly, not only revenue and expenses. When cash discipline becomes part of daily thinking, negative cash flow stops being a recurring crisis and becomes a manageable metric. Fixing negative cash flow is not about one quick trick. It is about controlling timing, improving margins, managing working capital intelligently, and building structural resilience. When you combine foundational discipline with advanced strategy, cash stops controlling your business. You begin controlling your cash. If you found this video helpful, then like, share, and subscribe this channel to get future videos.